Welcome to the March to a Million podcast with Greg DuPont, founder of the Wealth Solutions Network. In this podcast, Greg shares his journey to positively impact 1 million lives by creating an army of financially minded attorneys who embrace an expanded role in their clients' lives. Greg and his guests challenge the status quo in the legal profession and the financial services industry, and show attorneys how they can improve their lives, provide greater value to their clients, and experience greater professional satisfaction. Join us in this movement and strengthen your business by learning how to solve your clients' most pressing financial problems.
Hello and welcome to another March to a Million podcast with your host, Greg DuPont. Today, we're going to be talking about a lot of sorts of different kinds of plans that you can implement into your business. And with that short opening, Greg, take it away.
Thank you, Matt. Today, I'd like to introduce you to my friend. I like to call him kind of the business owner's secret weapon. Hello, Brad Barlow. How are you doing today?
I'm doing fine.
Great.
Greg, how are you?
I'm doing wonderful. So today we're talking to Brad, and Brad is an actuary. And so before you decide that this is not one that you want to listen to, because who wants to talk about numbers, I want to bring you into a vision of the world that Brad has exposed me to for people like myself, people like many listeners to the podcast, people that have spent their time building a business and now find themselves in a spot where, hey, we've got a fairly consistent, reliable income flow, and we're profitable. And now I'm behind the 8 ball on quote unquote retirement savings. I may or may not be able to sell this business the way I want to. How do I take advantage of what I have built? And that's where Brad comes into play. And specifically, Brad, again, is an actuary. His specialty, I guess, I'll use that phrase, Brad, you can correct me if I'm not allowed to use it, but defined benefit plans and those type of tools for business owners. So, Brad, welcome. Thank you for taking the time to join me today. And first, correct me if I'm wrong calling you a secret weapon for small business owners. And second, if you'd please provide us a little bit of a background on Brad Barlow.
I agree with the terminology secret weapon, though it's still surprising to me that it's a secret. These plans have been around for 60 years, almost 60 years. But always happy to help get the word out because they're great. I mean, for the right company and right prospect, it's just a great tool for building retirement assets and managing tax liability. I've been in the business since 1990. Started out at a Fortune 500 consulting firm. Just a very typical background. You start out as an actuarial assistant. You're working on larger clients, or those were the type of clients the office I was working in worked on. You pass some actuarial exams, you get more experience. You work, you get more and more responsibility. And that was the path that I was taking until early 2000s. The company I was working for at that time was sold. There was some reorganization going on. There were some layoffs, and I was one of the people that was. I mean, they offered. I could have changed locations, but I didn't want to. Luckily for me, I had worked on the implementation of a cash balance plan for a very large international law firm the last year that I was working in for the company that I was that let me go. That plan, I happen to know the managing director. He said that when the partners of that firm voted on that plan, they voted in favor of the plan 95% to 5%. And I said, well, it's a really good plan. He said, no, Brad, you don't understand. Lawyers never agree with each other. He said, you can't get them to agree on what time of day it is. He goes, they love that plan. So when I started looking for another place to work at, I thought, well, that's a pretty powerful testimony to that type of plan. So I looked for places where I could, do that kind of work, and I found it. But due to some personal circumstances, I ended up going out on my own. And since that time, I went out on my own in 2008. Since then, I've just been basically concentrating on small business, owner-only businesses, putting in plans that help folks put away a lot of money for retirement as quickly as they can.
So I'm going to kind of put some personality to this. Brad and I are working a couple of cases right now, and this is why I decided it was time to bring this message to you, the listeners, because the fact patterns of these two plans that we're working on are similar to many of your business arrangements. The attorneys that listen to this, many clients that you're dealing with, and you have to understand that the numbers go well beyond what you typically think of as retirement plan contributions. And so, one fact pattern, we have a client that is, he's got many businesses, some real estate businesses, but he's also got, he's a broker, and he has brokerage commissions that, because of his length in the business, are, high six-figure regular income that he can count on. And he's in his early 60s. Another client that we're working with is a salesman that has he's built a book that is now paying off significant revenues above and beyond what they need. And so those are two profiles that I want you to put a pin in terms of, okay, well, who do I know in my law practice or my orbit that are kind of people that may fit this plan? Because when we put the numbers together, we are talking about the ability to put in several $100,000 tax deferral. So what I want to kind of pull Brad back in on is, okay, that sounds too good to be true. Why does this work? How does this work? And I thought these defined benefit plans were only for big companies. And we're talking about, no, this is a real powerful secret weapon for small businesses. So Brad, can you kind of put some meat on that bone for me?
Sure. So there have been several changes to pension law over the last 40 years, and one of the last big changes to the law was addressing what large plan sponsors consider to be problematic funding rules, and they were problematic in the sense that, so if you're a big company, a big hospital, steel company, they were complaining to the IRS that the contributions that were required to be made to the plan were too onerous. They needed more flexibility. Okay. But the IRS also recognized that when times are good, these same companies needed to be able to put large amounts of money away in a tax-deductible basis. So they changed the laws, and they basically created this, based on the way they rewrote the regs, they created this big funding donut hole that the minimum is fairly low and the maximum is fairly large. And so that satisfied the lobbyists of these bigger plan sponsors. But the thing is, those same rules also apply to owner-only plans or small plans. So now, if you're an owner-only or small plan sponsor and you're looking to make up your funding because you've gotten a late start on it, now that maximum, because the way the rules changed, they really accelerated how much money you could get into the plan in the early years of the plan. And they did that. They did that in response to the lobbyists for the large corporations. But so It was not the IRS's intention to have this happen, but it was kind of a byproduct of what they did for larger companies. So it's just a great opportunity for, I mean, under the prior laws, it was still a good deal, but under the PPA, which happened in 2008, now it's a great deal. So the maximum amount you can put into plan early in the life of the plan is pretty spectacular.
And like the cases that we're working on, it's something that a person that is a late starter towards funding the plan actually has a greater potential for tax deduction because we got to fund the obligation and we got a shorter period of time to do it. Is that correct?
Well, so I think another way to put it, that I think the answer is the same, but what really is going on is that these plans work better the closer you are to retirement. So, you can put a plan in for a 25-year-old, but the contribution range for the same benefit at retirement is going to be much narrower than the contribution range for somebody who's age 60 and has only got 5 years. But the effect's the same. So what you said is correct.
And so, tell us about, complication. How difficult are these things to set up? How difficult are they to maintain? What kind of cost is associated with this for somebody that's considering something like this?
Well, so I would say the first thing to recognize is that these plans are not great vehicles for accumulating equity type assets. And the reason is this. The contribution to the plan is developed by calculating the liability, which is a byproduct of the participant's age, the plan document provisions, and some government mandated interest factors, less plan assets. So if your plan assets get too large, you can't make any more contributions. So, when I'm talking about these plans to folks in a seminar, I say, if you had a plan like a cash balance or defined benefit plan like we're talking about right now, and your plan sponsor said, I can buy a winning lottery ticket, this would not be the plan to put it in. Because when that lottery ticket wins, now that plan is full of assets and you can never make another contribution to it again. So you've kind of defeated the purpose of the plan. So that's one thing that you definitely need to be aware of. That plan sponsors need to be aware that these work best with lower yielding safe investments. So that, if you want to buy Bitcoin, put it in your 401k plan or your IRA. It's not expensive to put these plans into place. You have to pay for a plan document. There's some reporting that has to be done to the IRS. You have to hire an actuary like me to calculate the contribution range. That gets reported on a form to the IRS. So basically, when you're hiring somebody like me, you're hiring. What an actuary is doing is calculating the contribution range for the plan for the tax year in question. After that amount is contributed, filling out a form that is then filed with the IRS certifying that contribution has been made.
So let me just kind of summarize that and make sure I'm understanding that. So when you create a plan like this, as the business owner, you engage the services of someone like Brad, who is an actuary with experience in this field. And that actuary typically, at least in Brad's case, they'll be there kind of as your partner going forward on that. So, each year that actuary, creates the calculations that say, okay, this is the bandwidth of what the contribution can be this year. And they report the stuff to the IRS. All your job is, as the owner, is, okay, this is what I can afford to put into the plan this year. How does it fit within those parameters? And if my understanding is correct, Brad, that funding of that annual payment does not necessarily have to come from the actual cash flow generated that year. It just needs to be part of it's tax wise, it'll be deducted out of that year. Am I tracking that correctly?
Correct. So yeah. So and just like a traditional IRA or a SEP, the contribution for the tax year can be funded in the following year. You have up until, for a calendar year plan, you have up until September 15th of the following year to make the contribution. And where the money comes from, it doesn't have to come from the company that's taking the deduction, but that's where the taxes are going to be, that's where it's going to flow through to.
I also want to do fine tune to your conversation there about the nature of the investment itself, being a conservative investment in that. And the reason for that is we don't want to have that savings grow so significantly that it hampers your ability to put additional funds in it. And so I understand most of your plans, you not only have a defined benefit plan, but you also have a 401k plan. And so the idea is, if you look at that as a portfolio of retirement savings, defined benefit and 401k, you know that the defined benefit is going to be conservatively invested. So call it your bond component. And then your 401k is going to be where your risk is. Call it your equity component. Am I following you right there, Brad?
That's what I would recommend. I mean, I've actually had clients ask me, could they put Bitcoin in their cash balance or defined benefit plan? And I said, please don't, because, and I explained just what I explained to you. But even moderately aggressive portfolios, I was just talking to a client yesterday, and he had taken over the investing of, he and his wife have separate plans, and he had taken over the investing of those assets. And we had it's a calendar year plan, so we're talking about 2024. When he told me the contributions he had made already in 24 and the assets that were there in the plan as of yesterday, I did some calculations, and I told him, you need to move these assets to cash, because you were on the edge of making non-deductible contributions, which it would not be a good thing. Because if you make a non-deductible contribution, you have to pay a 10% excise tax.
Yeah. So let me unpack that, because I think there's a lesson in there, significant lesson in there. So that client, in their regular investment in their defined benefit plan, we're investing it in equity positions that, because of the growth of the market, it squeezed out the ability to put any more in this year, let alone put him in a position where he could have been because it's not until the end of the year that it counts.
Yep.
Then he could have over submitted. Okay.
Correct.
That is definitely interesting. Let's take a minute and focus on the 401k and kind of the mega Roth type of thought on that. So let's walk through that a little bit. So we got your defined benefit plan, then we have a 401k. What other options are there for people with a plan that has been designed to maximize your flexibility, like the ones you're talking about?
Yeah. So if you're an owner-only company, or owner and spouse, or partner only, and we'll talk about why those are the three profiles this idea really works for. But if you're any of those three types of businesses, and you either currently have a 401k plan, or you put a brand new 401k plan in, what you want to make sure is that the person who designs the plan, who creates the plan document, puts in the plan the provisions that allow what are called after-tax 401k contributions. Okay. Now, after-tax contributions have been around as long as 401k plans have been around. And originally what happened was, or the idea was, if you put after-tax money in, you don't get a deduction for the contribution, but you don't pay taxes on that amount of money when it comes out, but you do pay taxes on the investment earnings. So that didn't seem, I mean, I talked to a handful of people over the years that did that, but the paying taxes on the investment earnings kind of, made that idea seem not quite as attractive as it could have been. So go down the line, and the IRS or Congress invents this idea of Roth contributions. So Roth contributions go in after tax, but they grow tax-free and come out tax-free, right? So that's the difference. After tax, you just get your contributions out, tax-free earnings you get tax on. Roth, grow tax-free, come out tax-free. So what you can do is you can put after-tax contributions into your 401k plan, and then roll them either inside the plan or roll them outside the plan, but you make them a Roth contribution. So now everything comes out tax-free. So to me, that's a very powerful retirement idea. And there's another reason that can be attractive to business owners, or especially business owners where you can control the size of your W-2. Okay. So I set my W-2 at about $60,000 a year. So my 401k deferral, it could be a Roth deferral. Let's say it could be $30,000. After tax, the limit on what I can put in is either as a profit sharing contribution, which is the only other thing I can do, is basically 25% of my W-2. So 25% of 60 plus 30, that's what I can do, just not looking at this after tax idea, right? The after tax contribution, you can do the whole, what you can basically fill up what's called up to the 415 limit on the 401k side. So for 2024, if my W-2 is big enough, which I haven't said it yet, but I guess I could do a $73,000 after-tax contribution. So that means I could put $73,000 into and this is what I do. I put money into my 401k. It sits there one day, and then the custodian of that 401k rolls it to my Roth IRA. So that's why they call it a super backdoor Roth IRA. And of course, there's no income limit either. I mean, Roth IRAs traditionally there's an income cap on your ability to move money through regular channels into a Roth IRA.
So what I want,
and of course, you can invest that as you want to do really well. You want those assets to grow as you want to use all your investment acumen on those assets.
So where this fits in for consumer and counseling consumer on it is for people that are disqualified from making any significant Roth contributions and
correct,
because of their income. This gives us an ability to eclipse those numbers by using this tool. So we mentioned, the two use principles that that we're engaged in, but I kind of spitballing here. Other situations where this is a fit for clients that you're seeing. I imagine medical professionals, small manufacturing places, and things like that. Any curious kind of applications that you've come across, people that you say, yep, that people don't think about using this, but these people, these professions are really geared toward it?
Yeah. So if anybody who has a side 1099 business, or they might not be considered a business. I mean, I have a couple of plans for physicians who are on the board of directors of local hospitals. I mean, they get paid to do that. They're already making plenty of money, through the hospital, the jobs that they have as physicians at whatever hospital they're working for. They're putting plenty of money away for it through the hospital retirement plans, but they don't want to pay taxes on that money that's coming in as for being a director.
Mm-hmm.
So they can, so they have two choices, right? They can put a cash balance or defined benefit plan in, and they can put all that money away on a tax deferred basis, and they won't pay taxes on it. Or they could do what we were just talking about and set up a 401k plan and funnel, depending on the size of the 1099, they could funnel a lot of that money into a Roth IRA through a super backdoor Roth. Now the guys that I'm talking about, they decided they don't want to pay taxes, so they have defined benefit plans, basically sucking up all that income, and they're not paying taxes on it right now. Actors have production companies, right? Authors of books. I don't have plans like this, but I think they people the world is moving towards 1099 workers, and every 1099 worker needs to have this arsenal of tools at their disposal.
Well, I was thinking an Uber driver,
yes,
as a side hustle, making 20 grand a year Ubering, that doesn't need it for revenue, but he could use it for retirement planning.
Yep.
Could basically do that all tax free.
Yep.
Put it in a defined benefit plan. How long does the business have to be started before you can qualify to create the plan?
You could put it in you could start the plan the same time you start the business.
So in a minute here, I'm going to ask Matt to come back in because I have him serve as my fly on the wall. He always has some good questions that come from his observing. And I think he's probably right now he's applying to be an Uber driver so he can do this. And but before Matt comes back on, is there anything that you feel like we have missed for people to get an idea of this in a high level, as I understand it, for a few $1,000 investment up front to get these things set up, a similar annual fee, all of which is tax deductible. We have the ability to reap tremendous tax savings currently, and then we can plan on how the money comes out the tail end. And that'd be a whole nother conversation for another day. So before Matt comes back on, is there anything
the only thing I'd like to add is that right now the IRS is actually there are some tax incentives for starting 401k plans right now. I mean, they're not big, but when the IRS, they are not tax deductions, they are tax credits. So that's like the IRS giving taxpayers money. So if you're a solo business owner, start a 401k plan and get the tax credit.
Matt, are you done with your Uber application?
I don't have time to drive freaking Ubers, dude. What are you telling? But I love that. I love the idea of, a lot of people who are fiercely entrepreneurial definitely do have side hustles, and be able to get this defined benefit in place and be able to go ahead and fund it accordingly, I think is absolutely fantastic. Brad, I'm sure that there are going to be listeners who want to know more about engaging with you. Is there a good way for the listeners to reach out to you, or should they go through Greg specifically?
I have an email that I could share with you, or a phone number, but they could go through Greg as well. Either way, it will work.
All right. Well, we'll make sure that we put your phone number and your email address in the show notes. So if anybody wants to reach out to Brad directly, they can go ahead and do that. And as always, listen, if you are in the situation, which everybody, by the way, who's in WSN is in the situation to need something like what Brad offers, whether it's for your own business or businesses that you work with, please make sure that you share this podcast with other business owners so that they can find out this great information. So, and if you want to know more about joining WSN, go to joinwsn.com and make sure that you can join this network so that you can continue to grow your business and also just help your clients even more effectively. So for Greg and for Brad, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
Thank you for listening to the March to a Million podcast. Click the follow button to be notified when new episodes become available, and get in touch with our team by visiting our website at www.wealthsolutionsgroup.biz, or give us a call at 614-432-8065. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Wealth Solutions Network. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice from qualified financial service providers with any questions you may have.